Good morning. Not much to report from this morning's Bank of Canada interest rate announcement. No change to interest rates. No change to their guidance of still looking to raise rates in the middle quarters of next year. I mean, that said, the risks do appear to be to them raising rates sooner than expected. I mean, markets are pricing in one rate increase for March. There's a 50-50 chance before today of a rate increase in January. Might be a little bit early. I mean, in the U.S., inflation is starting to decelerate on rate of change terms. I mean, we're seeing signs of global supply chains maybe easing up. I mean, South Korea semiconductor exports were up 40%. Some data came out last week. So that's positive, and that would hopefully suggest inflation is maybe going to start to ease. As well, oil prices have come back down. There's no guarantees. I've been getting a lot of inquiries from clients who are in variable rate mortgages, worried about rates going up. Should they look to lock in? Yes, interest rates are going to start to go up next year, but that in itself should not be reason to just lock in. Fixed rates have come up quite a bit in the last 2 months. I mean, last year we had fixed rates close to 1.5%. Now we have fixed rates that are close to 3%. They've come up a lot. So if you're in a variable, I mean, based on current variable rate mortgages, they're roughly 5 to 6 Bank of Canada rate increases below the fixed rate, the 5-year fixed. So if you're going to lock in, because you're concerned about rates going up, well, you're going to immediately start paying more on that variable rate mortgage. And for locking in to be worth it, not only do we have to get those 5 to 6 Bank of Canada rate increases, but we have to see further rate increases beyond that point. Last time the Bank of Canada raised rates, it was a total of 1.25% over a year and a half. I mean, more than that is more rate increases than we've had in the last decade. So not to say it couldn't happen, I just wouldn't say that it's likely. I mean, the other thing to keep in mind as well with a variable, when you lock in, you're immediately taking on the risk of a higher penalty. Vast majority of Canadians break their mortgages early. So keep in mind that probably one of the reasons you went variable initially was because of that penalty, and it's important to keep that optionality. As well, if you're in a variable and Canada hits a recession in the next 5 years, you can take the benefit of riding rates back down. So you might see a little bit of pain in the next couple of years of rates going up, but you're still saving money versus current 5-year fixed rates, and you still have all that potential upside of being able to ride rates back down and have a lower penalty. So if you want to talk about this, feel free to get in touch. Love talking about this stuff, and more than happy to kind of go over your specific situation. The one thing that keeps coming up is, okay, in Canada in the 70s, 80s, 90s, we had mortgage rates that were in the double digits. Dynamic is very different nowadays versus back then. Back then, there wasn't anywhere near the same amount of debt in the system as we have now. I mean, a 1% rate increase right now has a much more significant impact on the economy than it would have in the mid 80s. There's a nimbleness that you get with the variable that has been the reason it's been the better play close to 90% of the time. So keep that in mind. And again, if you'd like to chat, feel free to get in touch. It's the last Bank of Canada announcement for the year. So I just wanted to thank you for watching and wish you and your families a very Merry Christmas. If you don't celebrate Christmas, have a very happy holidays. And we'll talk to you in the new year.